A series that I love running on this channel is the subscriber portfolio reviews, where I review portfolios of subscribers, peers, other content creators, and so much more in the dividend-focused space. The goal here is to promote transparency, which a lot of other big channels don't do on YouTube, also to learn new investing strategies and get more exposure to different stocks and strategies. And today we have a really good one. It's actually another sequel on the subscriber portfolio review series, and we're going over Dividend Data's portfolio once again. I'll be sharing my thoughts on his entire portfolio, what I'd like to see more of, what I'd like to see less of, and share my honest thoughts. I don't have any filters on it, no matter who it is. If that sounds like a plan to you, hit that subscribe button for me and turn on post notifications. Also, check out the Do Dividend Stocks.Drugs merchandise. Thank you, and of course, roll the intro.
Hello, I like money.
So before I get into the holdings, I typically like to know the investor's age, objective with the portfolio, goals, and so much more. Because what might my goals be may be different from his, and so on and so on. So Zach is in his 20s, and he's looking for a lot more dividend growth focused options, so his strategy is very similar to mine and just finding really high quality businesses. Now, Zach started investing, I believe, 5, 6, 7 years ago, and he's not the most experienced investor, and he's definitely continued to learn along with myself and all of you guys, I'm sure. But he's definitely matured a lot more recently when it comes to his investing strategy. I remember a few years ago he had like 30 or 40 holdings in his portfolio, and now you can see he only has 13. But right now, his portfolio value is sitting at $146,447.75. Out of that money, only $109,000 of that is invested. So right now, he has a 33.15% return and is outperforming the S&P 500. Go watch his most recent video where he talks a lot more about that. During Zach's investing process, he's definitely had a lot of trial and error and definitely a lot of losses and learning. A few examples of this are AT&T, Intel, Walgreens, even Realty Income, you could say. And look, I made the same mistakes that he did, and I actually kind of blindly copied him and went into a lot of these positions, but some of them actually turned out well for me, and I'm probably up in the long scheme of things. But this just goes to you guys to show, don't be like me. Don't copy other trades that big YouTubers or other people are doing in general. I made this mistake. I honestly blindly followed Zach into a lot of different companies that I would totally not own today. And that's nobody's fault but myself. I think if you're going to be watching finance YouTubers, you should find strengths in their investing style and implement them into your own investing style. Also, I think if they're teaching you about stocks and doing analysis and reviews on stocks, you should have that be like a gateway to your research on the stock. I would just watch one of his stock review videos and immediately buy the stock next day, and I'm not even joking about that. So back to Zach's investing strategy. He's young, he has a more dividend growth focused strategy, so I'm expecting to see some solid compounders on this list, and he is also investing for dividend income at the end of the day. I don't know exactly what time frame he wants to have this dividend income by. I know for the foreseeable future, he wants to just continue reinvesting his dividends, which I can respect. By the way, the holdings that we're going to be looking at today are on dividenddata.com, which is also the sponsor of today's video. I told you guys I'm having no filters on this video and my honest thoughts on the portfolio, and trust me, I still won't. So the software used to display his portfolio and all the dividend statistics and income today is on dividenddata.com. If you want to help support the channel and get access to this awesome software, use my link in the description. It greatly helps the channel. But starting by the largest holding, it's Microsoft, stock ticker MSFT. Today, Microsoft is now the biggest company in the world by the largest market cap. Right now, Zach is up 56.59% on his Microsoft investment. Now, I remember back in the 230s, 240s, 250s, me and Zach, we were buying up Microsoft. We were buying at the bottom of the dip. Now, we were buying mainly for Microsoft's cloud-based business, not the whole AI run that they've recently had. Hey, I'll take the added free cash flow at the end of the day, but I did not invest in Microsoft for the AI portion of it. They have an amazing business, and I honestly think it is the best business in the world in my opinion, and that's why it's the largest holding in my portfolio as well. His average cost per share in Microsoft is $240 per share, which is nothing compared to where it's at right now. I would do some unspeakable things to have Microsoft back at 240 and 230 like it was a year and a half ago. But at the end of the day, Microsoft's an amazing business. They have a pretty much guaranteed 10% dividend hike every year, and Microsoft is the purest example of the dividends are the result of a company's free cash flow. If you look at Microsoft's free cash flow and their dividend, it is practically the same. I definitely like Microsoft as his largest holding though, and I continue encouraging him to have it as his largest holding. I'm sure he won't be buying any more soon with that cost per share, but once again, I do some unspeakable things for Microsoft dip. Next, his second largest company and his third are kind of controversial ones. To start off, his second largest company is Altria Group stock ticker MO. Now, one could make the big argument that for somebody at Zach's age, somebody in their 20s, Altria is probably not the best dividend growth focused stock. And a lot of people are saying that Altria is a yield trap. Now, considering that Altria is his second largest position, it is kind of a riskier holding. I personally like having Altria as kind of one of those smaller positions in the portfolio. Currently, my dividend portfolio is roughly $22,000, and Altria is my only $550 position in the portfolio. It's not a very big position in my portfolio, but I'm still getting a good amount of dividend income at the end of the day and being paid to wait. I honestly think Altria is a strong business, but I think for a long-term time horizon like what Zach has, I don't love it as a core position if I'm being completely honest. Now, Altria has been trading at a pretty sizable decline as well, and always kind of trades at a natural discount, but I think $40 is actually really good value for Altria Group. But me personally, in our, a dividend growth based strategy, Altria has a near 10% yield right now, and they've continued to grow their dividend at a 3 to 4% rate every year. And that payout ratio is at 80%. I think as long as it stays there, the dividend is definitely sustainable. Altria is a strong business that actually produces free cash flow and has pricing power, so it is not a dividend yield trap in my opinion. With that said, I don't love it as a core position in the portfolio, and I'd like if he potentially trimmed at higher prices. But I do think it is undervalued right now, and I'm just reinvesting my dividends for now. The next company, once again, is a bit of a controversial one, but he is swimming in the green on this one, and it's ExxonMobil stock ticker XOM, and he's currently up 187.16%. Now, he bought an amazing time, and his cost per share is $34.82 on ExxonMobil. He bought during the C-19 crash in 2020, and I can't blame him for it. This was an amazing trade at the end of the day. It's paid off really well for him. ExxonMobil is even trading at 52-week lows at the moment, and still he's up 187%. Honestly, swear to God, I think if you're planning to have a holding like this for 50, 60, 70 years, I know oil will always be needed, but I think it would be worthwhile potentially trimming this ExxonMobil position and reallocating the money to some higher growth opportunities or even just an S&P 500 index fund. I think at the end of the day, there's limited growth ahead at ExxonMobil. They pay giant dividends, but one thing to keep in mind, dividends are not free money. At the end of the day, it's a taxable event. Dividends are not free money. It is passive income though, so I think his yield on cost would absolutely be insane right now with ExxonMobil. So I would consider trimming this if this were me, but I'm sure he is raking in dividend payments right now from that yield on cost. So at the end of the day, I think ExxonMobil, I'd like that more of a core holding than Altria, but that's just me. Next, I love this company as a core holding. It's Visa stock ticker V. Right now, he's up 17.73% on Visa stock, and his average cost per share is $221. Visa is such an amazing company. They're basically a legal monopoly, or duopoly, you could even say, with MasterCard in the payment processing industry. They have great pricing power, have amazing share buybacks, and great dividend growth. If you would have bought Visa 10 years ago, your yield on cost would be around 15% today, which is absolutely wild. I love Visa, and I'm really excited about what my yield on cost will be in 50 and 60 years if I continue holding this stock. Next, he owns Avgo, which is Broadcom, and he's up 97% on this one as well. I think Avgo is the right move for a semiconductor stock because unlike Intel, it is a fabless company with less capital expenditure required. Now, I get enough exposure through Avgo through my SCHD holdings, so I'm not personally looking at it this time, but I think it's a very strong company, and it definitely has the free cash flow growth at the end of the day. Speaking of a company that needs some free cash flow growth, next we have Disney. And Disney is his biggest loser in the portfolio, currently down 35.46%. Now, unfortunately with Disney, it's kind of taken an unforeseeable path so far in the short to medium term. But they have resumed paying dividends, and 2024 is supposed to be a big year for them when it comes to their free cash flow recovery. So, my Disney position right now, I'm down a lot as well. Look, I think there's a lot of uncertainty with Disney right now. I do like that they resume paying the dividend, but at the same time, me personally, as a consumer and somebody who wants Disney to do well, I haven't seen them do really good when it comes to creating any blockbuster films or any crazy new TV shows. When I bought Disney, The Mandalorian had just came out. I thought they had a lot of potential with that, but they just haven't had anything blockbuster or viral worthy recently, and it's really concerning as a shareholder. So I'm holding my Disney right now for sure. I'm definitely not selling, and it's going to be a position I'm going to have to reevaluate. Next is a company I'd like to see and buy more of in the portfolio, but it is trading near all-time highs, which is Apple stock ticker AAPL. Currently, he's up 57% on his Apple position. Apple has lackluster dividend growth, but they have quality and amazing share repurchases. Actually, historically amazing share repurchase program. Apple's dividend growth, though, has been pretty lackluster. It's been above where inflation is, but nothing really crazy whatsoever when I look at their free cash flow. So hopefully, over the long term, once they're done buying back like their entire company worth in shares, they'll start doing dividend increases. The next holding is a company I'm personally not a huge fan of, which is T Rowe, stock ticker TROW. Now, he's up 2.3% right now on T Rowe, and I think T Rowe, I don't want to say it's a bit of a value trap, but I think there is a lot more certainty and a lot of other businesses with a lot more predictability than T Rowe Price. I also think that the way that some money markets and management has really gone, I don't love the way that T Rowe has gone. A lot of people are doing their own trading nowadays instead of buying T Rowe funds. But at the end of the day, they have a really, really good yield right now. They historically have had really quality growth, but not recently. I don't personally love T Rowe. I know there's a low PE and a high dividend yield and historically high dividend growth, but I just don't love it in the portfolio. I think there's a lot more better predictable options. So, me personally, I don't love this position. But the next company I do really like, which is Kroger's Dr. KR. I think Kroger has a lot of potential with AI and automation, as I've talked about on the channel before, and I think they do have a lot of potential, especially if the Albertsons merger goes through and that dirty witch Lena Khan stops trying to steal shareholders' money from Microsoft and other companies that just have really good businesses. But no, at the end of the day, I think the big thing with Kroger is just seeing more free cash flow consistency. They just increased their dividend 11.5%, which is amazing. Their investments into automation, I believe, will quite literally pay bigger dividends in the future, and I really like Kroger. The next company is Pepsi, stock ticker PEP, which is more of a staple in the portfolio, and he's up 39.55% on it. I think there are better options than Pepsi, but I definitely do think Pepsi has more growth ahead of it than a company like Coca-Cola. Pepsi, though, has growth in both food and beverage categories, and they have quite literally iconic and irreplaceable brands. So I do like Pepsi a lot. Next, he has an MLP, which is Enterprise Products Partners, EPD. Now, he's up 71.81% on this holding. It's basically an energy company. Now, they pay giant dividends, and he's up a lot on it right now. And me personally, if I were up like that in a company like with limited growth like EPD, I'd personally sell. Also, for tax reasons, he might want to sell as well. Since MLPs and REITs are not taxed as qualified dividends, that may be another incentive for him to potentially trim or sell his position. But they do offer a really big yield for him right now. Speaking of another company that offers a really big yield for him, he owns Chevron, stock ticker CAVX, and he is up 84.33% on this position. Once again, another energy holding. He bought at a really good time. I don't think energy's going anywhere, but I think there are better options for the long, long term. And look, I understand that he bought at a really, really good time with these energy companies, but at the same time, I think in the short to medium term, seeing this yield on cost grow can be really, really motivating, especially for companies like these. And I don't want that exactly to translate. Me personally, I wouldn't want that to translate into a company like Altria, where I think that could happen again. But I think there are a lot better long-term options when it comes to growth and total returns at the end of the day. And lastly, in his portfolio, he owns Automatic Data Processing, stock ticker ADP. Now, this is a company I'd like to personally research a lot more, but from the financials and a quick look, I really do like it. So overall with the portfolio, what would I like to see more of and what would I like to see less of? I said I'm not going to filter anything out because he is a sponsor of the channel, but I'm going to be completely honest here. They're definitely a scatter of a lot of different kind of companies. There's a lot more stability in here, there's a lot of high growth, and it's honestly a big mix. Now, me personally, I'm kind of moving away in my own investing strategy from that mix as Zach's portfolio kind of is. But he's really in the green on a lot of some of these energy companies. It is weird to see a portfolio where the core holdings are energy companies and Microsoft and Visa. It's just kind of honestly a mix. And I'm kind of curious to hear what the long-term direction of the portfolio is. I'm curious if he's going to naturally move away from kind of that, low high yield, low growth. Moving on to his projected income tab, we could say that his income is a little heavy when it comes to his energy side of things and Altria, and that makes up a huge portion of his dividend income, as you guys can see here. Now, once again, you can get access to this tool using dividend.com. Use my link in the description. It helps support the channel greatly. Every year, he gets $4,280.66 in dividend income. Every quarter, $1,070. Every month, $356. Every day, $11.73. And every hour, nearly 50 cents. Those companies like Altria, ExxonMobil, Chevron, EPD, Those make up a big part of his dividend income, as we can see on the chart. That's like nearly 75% there. And me personally, if I'm investing for 50, 60, 70 years, I don't know how great I personally feel about that. Obviously, you want dividend growth and dividend yield on cost to pick up at the end of the day. I want to thank you all so much for getting the video. If you appreciate this kind of content, hit that like and subscribe button for me. Check out Dividend Data's channel, link in the description, and dividenddata.com. Use my link in the description. Also, check out the Do Dividend Stocks Drugs merchandise if you haven't already. Really nice looking, awesome winter beanies now available. Very comfortable. Alright guys, thank you for watching, and Do Dividend Stocks Drugs. Have a good one.